So, and then a personal loan is a loan taken out by an individual and paid back over a fixed period, typically 1 to 7 years. Interest rates on personal loans are often fixed for the life of the loan. I think in South Africa they are often variable, right? They are linked to the prime lending rate, which is in turn linked to the repo rate. So when the Reserve Bank so 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 when so when the Reserve Bank changes the repo rate either up or down by those basis points, the prime lending rate will also be affected. In turn, the interest rate on a customer's loan will also be affected. So that is the personal loan interest. Okay, one example is a car loan. Car loan is also a form of a personal loan, but it's secured. It is taken out to buy a car and secured on the car. Otherwise, personal loans are generally unsecured. Okay. And then corporate loan is a loan that is a loan by the bank to a company. Corporate loans are normally variable rates. Personal loans in South Africa are also normally variable rates, right? Unless if it's a unsecured personal loans, I should say, unless if it's a vehicle finance or a car loan. Those ones you can opt to have a fixed interest rate or a variable rate, right? But then the fixed rate is usually higher than the variable rate, right? Yeah, because I don't know exactly why that's the case, but I would like to think is that if you opt for a fixed interest rate, you are sort of like insuring yourself against interest rate volatility. If for some reason if currently the prime lending rate, what is the current prime lending rate? Let me just check. Current prime rate in South Africa. So currently the prime rate is 10.25%. So if for some reason, if you take out a fixed interest option on your car loan, it will generally be higher than the prime lending rate or than a variable interest rate. If say a bank charges you prime plus 2%, meaning if you take out a car loan, say on a variable interest option, they could say they charge you prime plus 2, which means that if the current prime lending rate is at 10.25%, then your interest on your car loan would be at 12.25%. That variable rate that you get will generally be lower than a fixed interest rate option. A fixed interest option could be prime plus 3%, for example, and locked at that prime lending at that rate, right? So you could be charged on a variable interest rate option, you could be charged a 12.25% if the prime is 10.25, but on a fixed interest, you could be locked at 13.25%, right? For the entire duration of your car loan. If it's 6 years, you will pay 13.25% for 6 years. Whether the prime lending rate goes up or down, it doesn't matter. So that is sort of like some form of certainty from your side as the consumer that you want fixed installments. You don't want your car installments to be going up and down. But for the bank, they sort of like lose out. For the bank, if the prime lending rate or if the repo rate, which is linked, if the prime lending rate goes down and your interest is still fixed at 13.25%, they are making more in terms of interest from your car loan. But then if the prime lending rate goes above that 13.25%, for example, and you are locked at 13.25%, you see the benefit of having the fixed interest rate on your car loan, right? Okay, not to dwell too much on this, but that's generally how it works.